The wife and kids are in bed, and that means we can start our beatdown on Intel. What is going on, investors? Hopefully, guys are doing well out there. Intel reported their Q3 earnings. We also got Q4 guidance, if that's what you want to call it. We'll come over here and we'll look at the declining revenues. We'll take a look at the increasing costs, the declining operating profits, the declining net income. We'll look at the declining cash flows. We'll look at everything going in the wrong direction for Intel, except for the stock price. In the after hours, this one actually starting to climb back. And I think that's not only a good sign for Intel, as the stock is down over 45% over the last year, the fact that the market is digesting these absolutely disastrous earnings reports and disastrous guidance, not only for the fourth quarter, but we also got full year guidance, which came underneath expectations for Intel. And the stock actually went up. So what's that showing me is not just for Intel, it's the market is pricing in just some really, really, really bad news. And when the news is just really bad, well, the stock actually reacts positively. And I think that's what we saw with Intel. Obviously, again, over the last year, stock's down 45%. It's tremendously been beaten down. You got a $112 billion valuation on this one. When you look at any price to earnings, price to sales, it looks like a value stock. When you look at the yield, okay, you got over a 5.3% yield on this one. So that's certainly beneficial to a lot of shareholders as well. A lot of the bad news and the bad stuff is priced into Intel, but this quarter was still really, really bad. Revenue came in at $15.3 billion. That was a negative 15% year over year. Look, there's not a stock in the stock market that's going to get a premium valuation that is going to put up a negative 15% growth on that top line. Now, here's the other thing that was pretty bad. Our Q4 guidance was for between $14 and $15 billion. The consensus estimate was for $16.43 billion. Folks, there was actually analysts that were thinking this company could do $17.34 billion on that revenue side. I tell you what, that guy should probably lose his job tomorrow. Company probably going to come between $14 and $15 billion. In the most recent quarter, they were expected to do $15.3 billion with the high end estimate close to $15.75. Like I said, they came in at right around $15.3 billion. Again, these expectations have been brought in over the last year. We also got full year 2022 guidance for Intel, expecting revenue, this would be non-GAAP revenue, of about $63 to $64 billion. The consensus was about $1 billion higher, close to $65.35 billion. And those earnings per share, and this is a non-GAAP EPS figure, expected to be about $1.95. Consensus was actually for $2.52. So they disappointed for the upcoming Q4 guidance. Not only on that revenue side, we didn't talk about how non-GAAP EPS for the upcoming fourth quarter expected to be just 20 cents per share. Consensus was more than 100% higher at 50 cents per share. So they've really missed the mark at Intel. And that's why the fact that this stock is trending up in the after hours, it gives me hope, not necessarily for Intel, but for the market in general, that there is so much bad news priced in these stocks. They can lay up just one of the worst quarters that you could possibly think of, a worst guidance that you could possibly think of, and the stock is actually trending up in those after hours. When we look at this stock going forward, we have to imagine that even though these revenue estimates barely move, you go from like $15-16 billion, you occasionally touch $17 billion on these revenue estimates, that's where Intel's going to be. It's going to be a no growth company really out into infinity, at least for the, I would assume for the next 2 years. The company is just barely going to grow from a revenue perspective. We won't see it on the most recent earnings, but they should have some cash coming in the door. They released a little bit of their stake in Mobileye, company completing an IPO this week, valuing the company close to $861 million, which was not much more than what Intel had paid for the company. And my guess is after banker fees and all that type of thing, they really just got back a little bit of money. Now, Intel still owns owns a majority stake in this. So as goes Mobileye stock, Intel stock should actually react a little bit to it. Okay, it won't be dollar for dollar, point for point, but let's say Mobileye has a great quarter and it goes up double digits, like 10, 15%. Well, Intel will likely go up a point or two along with it, considering they still maintain a majority stake in this company. We'll see evidence of Mobileye's revenues when we get over to the financials at Intel. Revenues coming in, like we talked about, at $15.3 billion. Again, that was in line, but it was down 15% year over year. Last year, you're at closer to $19.2 billion. Take a look at what happened to your cost of sales. They went from $8.5 billion last year, or 8.4, up to 8.8. Guys, that is just so sickening that your revenues can go down 15%, but your cost of sales actually went up. That is just showing you have just a really, really bad product. So take a look at what happened to your gross margin. Last year, you were at $10.75 billion, all the way down to $6.5 billion. Now, unfortunately, they have not cut costs fast enough over at Intel. Your research and development went from 3.8 all the way up to $4.3 billion. Your selling, general, and administrative fees went from 1.7, this was relatively flat, up to about 1.7, up fractionally, about $100 million. And you had some restructuring charges as well. Give a company a pass on those. That was for $664 million. They easily have to restructure over this company based on these financials. Your operating expenses went from 5.5 billion all the way up to 6.7. If you want to strip out these restructuring charges, you still went from 5.5 up to about $6.1 billion in operating expenses. I can't emphasize how bad this is. And it's just not, people think I have this vendetta against Intel. Folks, change this symbol over here below my face to any company where your revenues decline 15%, your cost of sales increase, your operating expenses increase, and I'm going to try to hold back from puking out my dinner here on the table. This is just a disaster from a business perspective. You'd expect actually all of this to go in the other direction. When your sales go down, yes, maybe a quarter, it might take a quarter or two, but we're like a year into this for Intel. They continue to see, especially their cost of revenue, that continues to go up, and everything else just continues to trend up as their revenues continue to fall off a cliff. That gave you operating income. You actually lost money this quarter over at Intel. Last year, you made a solid $5.2 billion. This is why the stock was like 45% higher, because look, if you hide the left-hand column here and you just focus on 2021, these are fantastic results. $19 billion, $10 billion gross profit, $5.2 billion worth of operating income. I'd want to invest in that company. So I don't blame yourself if you bought Intel a year ago or 2 years ago. These are fantastic numbers, but just this is why we go through these numbers every time here on the Investor Channel, to show you when they turn the corner, you want to start jumping ship. We did that with Facebook or Meta. We're not trying to pat ourselves on the back here. We don't get it right every single time, but we get it right a large percentage of the time. When these numbers start to turn, you got to jump ship. We did it with Nvidia. We did it with Meta. Amazon puts up another bad quarter. We're going to be jumping off of that ship here in a minute too, because this quarter is a disaster. You swung to an operating loss. You come down to net income. They got a nice benefit from income taxes. So your net income came in at $1 billion. Again, due to the fact that they got a $1.2 billion benefit from income taxes. Last year, though, you're sitting on $6.8 billion worth of net income. This is why we don't always flow all the way down to net income, because you see here, it's deceiving. They had 25 cents of earnings. Last year, you had $1.67, but it is even worse than that. This is why I encourage you, just make it so much simpler on yourself. Stop at operating income. You stop right here. You see the company lost $175 million operating the business. Yeah, they got some funky benefit from income taxes, but that has nothing to do with running the business. What has happened to Intel is they've they've lost control of their business, and it doesn't look like, at least according to these results, it's coming back anytime soon. You come down over here to the balance sheet, and it's a reason why they spun out that Mobileye, and they'll probably continue if that stock performs well, this MBLY stock. If it holds up and it performs well, they'll continue to sell their stake in it because there's just simply bleeding money over at this company. You see here from a cash perspective, you've got about $22.5 billion in cash. You got another 7.5 in receivables. What I don't like about the receivable line is the fact you went from 9.5 down to 7.5. Usually receivables means that you've got some orders coming in and things are pretty plentiful. Well, your receivables are down $2 billion year over year. That is not a good sign. You had over $28 billion worth of cash last year. And again, more in receivables. You come down here to inventory and you see that inventory is up. So you've got your sales down. You've got your cost of goods are rising. Your profits are down, but your inventory is up. It is just showing you that the products that Intel is making just are not hitting the mark. And I tell you what, I know that there's going to be fanboys watching this. You've got to be able to just admit this to yourself that Intel's products just are not hitting the mark. They just aren't. They've got too much inventory. You went from 10.7 up to about 12.8. You look at the total current assets over the last year. In fact, this is not even over the last year. This is from December to October of this year. You went from $58 billion worth of total assets all the way down to about $49 billion. Come down here to liabilities. Short-term debt down a little bit. My guess is when we get over to cash flows, they probably paid a little bit of that off, or they just rolled it over here to long-term, because notice your long-term debt went from 33.5 all the way up to $37.2 billion. It's just simply not good from a balance sheet perspective, certainly when you dissect that inventory number and those receivable numbers. When we come over to cash flows, maybe there's some saving grace here, but spoiler alert, no. So you got $15 billion worth of net income last year. Okay, this is on a 9-month basis for Intel. Last year, you had $15.2 billion. We'll call that $15.3 billion worth of net income, all the way down to $8.7 billion of net income this year. You've got some depreciation. You've got stock-based compensation. You've got other things that you can add and subtract. You get down here to the net cash provided by Intel's operating activities, and you can see how this has just fallen off the map. This is what, down 75% from $24 billion worth of positive cash flow last year, all the way down to $7.7 billion. This has been the definition of a value trap, because a lot of people would have bought this company back here. The price to earnings, the price to sales, all the multiples look good. But when you looked at the forward estimates, you looked at the competition, you looked at the business trends, you knew something like this was likely going to happen with Intel. I don't think anybody really would have expected it to fall off the map this much. But when a company's revenues are starting to slow and they don't have a lot of pricing power, they don't have a large moat around their business, especially when it relates to their competitors' products, this is the type of thing that can happen. Now, they are still investing in this business. Addition to property, plant, and equipment, $19.1 billion. And folks, they've barely broken ground. I think they've put like a shovel in the ground for these fabs. I know that's going to be the other bull case argument. It was, oh, they're building this fab in Arizona. They're building it in Ohio as well. Yeah, that's great, but how much money is that going to cost? Sure, they're going to get tax incentives. They're going to get a couple of handouts from the government. They've partnered with another company in Arizona, so I think that's good, but then they're going to have to share half of the profits. But look at this. Year over year, you spent $11.6 billion on plants last year, all the way up to $19.1. And again, this is off of $7.7 billion worth of cash flow. So you've got these cash flows that have completely fallen off the map, and you've almost doubled your property, plant, and equipment spend. That is extremely alarming. They issued some long-term debt here, about $6 billion. They paid back about half of that, $3 billion. Now, they did do the wise thing. They didn't repurchase any common stock. Now, it would have been smarter to maybe save the buyback when they were buying the stock over $40 and $50 and $60 per share. Maybe saved it for this. But look, at least they have the financial discipline to do that. The next thing they got to do is get rid of this dividend over at Intel. They paid $4.5 billion worth of dividends last year. It was 4.2. They've got to get rid of that dividend at Intel. It's just, this is not not going to work. Otherwise, they're just going to have to continue to take on more and more debt. And if you're of the belief that the Fed will probably pause but not cut rates, at least in the shorter term, well, they're going to have to borrow this money at a relatively higher interest rates than you probably would like them to. This $4.5 billion that they spend on dividends, I think, would be better off just investing into this company. If you believe in this company in the long term, probably something that you would believe in. Now, in terms of their segment operating results, you've got that client computing. You saw desktop actually hold up relatively nicely, so they're doing a good job in that market, but really that notebook computing really falling off the map. I actually just think Apple's products are so much better when it comes to notebooks, and it's possible Intel's working on something that can compete with that, but for right now, I just don't think it's there. But all things being considered, actually the PC business actually held up a little bit better than I thought. It went from 9.8 down to about 8.1. It was really your data center and AI that really fell off from about 5.8 down to 4.2. So AMD and probably a little bit of NVIDIA eating their lunch there. You've got network and edge that ticked up from about 2 billion up to about 2.3. That's nice to see. Accelerating computing and graphics from 171 to 185, kind of an infancy business. I think they've rolled out some new products there with Intel that have been relatively decently received. I think their pricing is pretty aggressive there, so those might sell, but I don't think it's obviously a rounding error when it comes to their revenues. You have Mobileye, which is obviously a separate business. My guess is you won't see reporting on this in future Intel reports, but obviously you can go over to Mobileye and pull up their financials and see in the most recent quarter they generated $450 million worth of revenue and about $142 million worth of operating profits. Again, not a large business, but really nice growth. Okay. They went from 326, again, referring to Mobileye, up to 450. It's not a stock I would touch at the current valuation, $850-60 million. Seems pretty richly valued in my opinion, but one that certainly has a lot of potential since they also are churning out operating profits. The client computing though is what we saw that you had. Yes, you didn't have as disappointing revenue drop from about 9.8 down to 8.1, but look where you had the really disappointing drop. As you come down here to operating income, you went from $3.6 billion worth of operating profits all the way down to 1.6. So basically cut in half. That's really yucky. Your data center and AI got destroyed, 2.3. They're basically giving these products away at Intel, probably to maintain some market share and maybe maintain some relationships with these clients. And this is probably not good news for AMD and NVIDIA as well. If Intel's being this aggressive on pricing, those companies, despite probably having superior products to a certain degree, are likely drop. I mean, we know that those companies are dropping their prices essentially across the board. That's what you're seeing with Intel is their sales are dropping. Their ability to control pricing and increase pricing is dropping as well. And speaking of dropping, obviously this stock has fallen off a cliff over the past year or so, peak to trough. I mean, you're down over basically 65% on this one, but I've got a weekly chart with this stock. You see these red lines that we made here. We obviously had the depths of the financial crisis back in March of 2009 when most stocks bottomed, and it went on a rally. And look, these rallies have to end at some point. And like most stocks, this one ended at the beginning of the year. The stock finally broke out of that trend and it's over. And now we're in kind of what I would call this lower consolidation area with Intel. And I tell you what, if for some reason you like a company that has declining revenues, declining market share, declining profit margins, declining cash flows, probably going to have to cut the dividend or eliminate the dividend if those things obviously continue. Well, this is a company that I think you probably could accumulate between $20 and $26. Right now, it's at the top of the range. I wouldn't be interested in it. But again, I'm on a weekly chart. This goes back the beginning of this consolidation area. Now, there are areas lower on this consolidation area that start about $15, $16 per share. But the bulk of the price action over the last, we'll call it 30 years with Intel, has occurred between about 19 up to 36. So I wouldn't want to accumulate up at 36. That's where your resistance is. If Intel goes on some kind of mini run and goes from 27 to 35, it's going to hit its head on 35 and pull back. If I were to buy this stock, it would be somewhere south of where it's at today, somewhere south of $27. $7 per share. There should be some pretty significant support for this stock right about $20, both from a psychological level, just kind of a round number, but also from, I mean, it found support at $20 for basically 30 years or so. So Intel essentially kind of in the middle of a 30-year trading range. So it's not like exciting, but it's not the worst spot, especially if you believe the momentum is back in this name. You could play it from 27 back up to 30s. I would at least take some small profits in a name like this. You see here also just showing you this sideways chop that this stock has. In order for you to make money on this stock, you would have had to realize some gains over the long term. Obviously, that dividend there is there as well. The CEO and the company seems very steadfast in maintaining this dividend. From these results, I just don't think that's going to be possible. Just understand that every executive I've ever seen over the years that had a dividend that was too high would always support it and support it and support it all the way until the end. And then finally you get that kind of pulling of the rug of that dividend, and the stock usually reacts pretty negatively. So if I were to have kind of my Miss Cleo crystal ball, I would say that is probably going to be your washout moment with Intel. At some point, the executives will realize that dividend needs to be pulled off the table. That will flush out the rest of the investors, probably push this stock down to about $19 or so. That would be the first area where I would actually get excited about this stock. That's just simply not enough to be excited about when you have declining revenues, declining profit margins, declining pretty much everything over at Intel. But I think the good news, the silver lining, is the fact that a lot of this is already priced into stocks like this. And I'm more confident than ever after this earnings season that we're actually closer to a bottom in the stock market. And that confirms that accumulating stocks, even though there is a lot of volatility and yeah, you're going to time some of these things, it is probably the right strategy going forward, because the Fed will pause, and the minute they pause, that is going to be viewed as a pivot. Hopefully, guys, enjoyed today's video. We'll be back again soon with more. Any interesting stocks like Shopify and a few others, we'll probably shoot them over into the weekend. We'll have our Fang Stock Recap show tomorrow on Friday. Have a great rest of your day, and good luck with your investments.